private company Business School and the J.L. Kellogg Graduate School of Management, and he is a certified public accountant and a certified management accountant. So he comes to us with a lot of finance experience. We're also pleased to have Ron Warwick here. Ron, if you could just raise your hand. He is a commercial loan officer with our partner institution, FSC First. They're also here on the third floor of this very building, 1801 McCormick Drive. And you can see FSC First has a table in the back, so I encourage you to during a break, to be able to attend, visit their table, and learn more about their financing programs. I also wanted to introduce Rod, who is one of our SBA partners, so the United States Small Business Administration is supportive of our efforts here, and we thank him for coming. I would also like to recognize our partner from City First Bank. We also have other bank partners that will be here throughout the series of this program. I would also like to recognize SBDC and Mark Wells in the back. They are one of our technical assistants counselors, and they can actually help if you're putting together a business loan package. Mark has a banking experience. Mark, why don't you wave to the crowd so people know who you are? There you go. Thanks so much. And then, of course, our very own Prince George's County Economic Development Corporation, which I must say I'm pleased to have in the room. David Lewis, who is one of our business development, sorry. And then we also have John Mason, who works with some of our manufacturing companies and other businesses, construction, etc., in the back of the room. Kathy Barber, our development manager, who is responsible for helping us to put together today's program. And we'd like to thank Wells Fargo for supporting this program. And of course, our stellar marketing communications policy team. So I would like to recognize Laurie Valentine and her team, who are all helping to support to bring this session live to others who are not able to be here in the room today. So without further ado, I'd like to turn the program over to Ron, who will because during the last session we talked a bit about business plans, and not everybody in the room had a business plan. So just real quick, Ron is going to point to some things that you have in your handouts and your books, and then we'll go back to Matt, and Matt will get into a deeper dive on the financial elements of your business plan. So here we go.
There's a traditional business plan outline, and also a lean startup business plan outline. There is in the back of your notebook is an example of a traditional, actually an example of each. Just wanted to point that out. That information is all online at the SBA website. On the first page there should be a link at the SBA website where you can go and learn all about business plans. There are some templates there that you can use to prepare your business plan. But I do want to point out that if you're looking for bank financing, focus on the traditional business plan. It's a little more detailed. That is what we look at as an underwriter, and we scrutinize. Assumptions need to be justified. Any supporting documentation, be sure you include that, and really leave nothing to the imagination, and that'll help you get your financing you're looking for. Okay, so I just wanted to point that out.
You want me to go ahead? Okay, let's get started here. So if we can bring up the slide here. And basically what I'm going to try to do here in the next 2 hours, we're going to try to cover the financial elements of your business plan, okay? And the thing is, when you go to Ron or some of these guys like the SBA or this guy at the bank, and you want to get money from these guys right here, okay? They're going to probably go look at your numbers. A lot of times you've even told me, point blank, that I don't even read the business plan. I go to the financial numbers first, right? Is that true? Okay. So if you're going to go to Ron or somebody like these guys and ask them for money, you've got to get financial elements into your business plan. Otherwise, you're going to get rejected pretty fast, right, Ron? A lot of questions are going to come up if you don't have these financial numbers, okay? So it's absolutely, absolutely critical. So, by the way, when I talk about financial elements, let's talk about what are you exactly talking about when we say financial elements, okay? In the eye of the hurricane, the real core of this thing, more than anything else, are financial statements. You've got to project out financial statements. Okay, that's really, really critical because these guys are going to take those financial statements, right? You're going to look at those financial statements, and they're going to look at some certain things to see whether or not do you have borrowing capacity? Can you make the loan payment? Stuff like that. We're going to talk about those kind of things here in a minute. And we're going to point those things out. I'm going to point out the tripwires. They're going to go when you talk to these guys and go for money. So you've got to have a balance sheet. You've got to have an income statement. This is kind of the minimal pieces of the puzzle that you've got to put into your business plan. And more than likely, you're going to have to project that out for at least 3 years. Right? Chime in if you want to. 3 years, okay? Not only do you need the financial statements, but you got to tell me where you're going to get the money from, sources of money, and how you're going to apply the money, okay? Where you're going to get the money from and where you're going to use the money. That's going to be your startup budget. Total funds needed, where you're going to get the money. Can't all come from the bank. You got to put some money in yourself, right? Okay? So you got to tell me sources and applications of funds. I got to have financial statements in this business plan. And if I put a financial statement in front of you, the financial statement doesn't really tell me much. So it's a good idea to have something that's analytical on top of the financial statements. So there's 2 popular analytical models we like to put on top of the financial statements. One of them is called break-even analysis. At what point do I break even? You may lose money at first, right? And eventually start to make some money. At what point do you break even? The most popular thing that you can do to analyze a set of financial statements in the United States, bar none, is to calculate a ratio. A ratio is just one number divided by another number. Okay? So you need to understand something about that because these guys are going to probably calculate some ratios, right? Okay, so it's a good idea to know what those ratios are before you walk in and see these guys, okay? So you need to understand that. You got to document some key assumptions. How much stuff do you think you can sell? At what price? What are those assumptions? We're going to have to talk about that. What we do at SCORE, one of the key takeaways I'm going to give you from today is I'm going to give you a link, and you're going to be able to download the SCORE workbook model to develop a comprehensive financial plan for your business plan. I'm going to give you a blank version of it. I'm going to give you a filled-out example of it. I'm going to give you a PDF template that you can fill out to complete the model. So you're going to get 3 key takeaways from this 2-hour session. That's probably the golden nuggets out of this whole presentation, okay? So hang on to that. And by the way, we'll go through that spreadsheet model later on in the session, okay? So let me go to the next slide. Whoop, let me go back up. But what I want to point out here is there's a lot of moving parts to this thing. So if you decide if you're going to say you're going to sell so much stuff, that affects your sales revenue. That affects cash. So we need to really put all this together in what I would call a financial plan. And what we really need to do is use an Excel spreadsheet to put all the pieces together. So really, if you do this right, you need to do it in a spreadsheet model. That's kind of what I'm telling you. And again, I'm going to give you the spreadsheet model today so you can figure all this out. Because you got to figure out the inputs. How much you're going to sell, at what price, what monthly expenses do you incur? Maybe we have some one-time investments. Maybe you have a delivery vehicle for a restaurant or restaurant equipment. You have recurring monthly expenses, all right? And we'll break that down a little bit. And from all these inputs, I get these outputs. These 2 financial statements are very critical, and there's a third one that's not a bad idea to put in there, and that's the statement of cash flow. So really, when we do a really good job, we want to cover the financial statements, okay? Balance sheet, income statement, statement of cash flow. Now, I think the first session touched on the financial statements. Is that right? So if you attended the first session, you should have gotten some exposure to what those financial statements are. If you need help, you can sit down with a CPA or an accountant or a bookkeeper or somebody else, okay? But I've got to estimate what my revenues are. This is a real first watershed event in developing this, and I've got to figure out what my startup budget is. Okay, and this is all going to go into the spreadsheet model, and it's going to dovetail into your business plan. Okay, so this is what we're going to talk about today. Next slide, if we can. I like to write a little bit, so I might write so I can kind of drive these points home to you a little bit better. And what I want you to understand is the following. If I can bring this up. Because you've got to tell me what you're going to sell. Okay? Absolutely positively have to tell me that. And basically, and in order to figure out what that is, you got to tell me how much stuff you're going to sell. That's volume times sales price. Okay? Volume times sales price equals sales revenue. So you got to take your best guess. Tell me what you're going to sell at what price. Okay, and I know that's not particularly easy, but you got to have people go make observations. They get trademark data, they get trade industry data or something like that. Volume times sales price is sales revenue less volume times unit cost is what I call the direct cost of what it is you sell to the customer. Okay. So you're going to have to figure this these are the real hard parts of the puzzle you're going to have to try to figure out, okay? Not easy, but you got to tell me let's just take an example. I'm going to sell let's just take a stupid example maybe. Let's just say you say 100 fruit baskets, okay? Let's keep it real simple. And you sell it at $5. That's $500 of sales revenue. How much does it cost you to actually make the fruit basket? Okay, I got to buy fruit, I got to buy a basket, I got to do this, I got to do blah, 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 blah. What is that? Okay, how much does it cost you to do one fruit basket? $1. Okay? Direct cost of what you produce, deliver to the customer, sales revenue. This is what's called the gross margin. And if I divide this by this is called the gross margin percent. And every person should know what their gross margin percent is. Because if it ain't high enough, you're not going to be profitable. You ever watch Shark Tank? They always ask, what do they ask? What's your gross margin? What's your gross margin? Why do they ask that so much? Because they know if your gross margin is not high enough, there's no way you're going to be profitable. Okay, there's no way. Because why is that? This is just the direct cost. Below here, I have all the indirect cost. I got to pay fees, insurance, rent, utilities, Facebook ads, blah, 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 blah. So this is all the indirect cost that's not directly associated with the product or service that you have, okay? So that leaves maybe $100 of profits. Then after that, by the way, that profit's going to pass through your personal tax return. You got 16% self-employment tax. It's going to go against that. So that's why you got to have a high margin. Why do I have to have a margin of 40%? Why do I insist on that? Because you've got to cover a lot of stuff besides just that direct cost. Okay, so that's the reality of business. Okay, so you got to have to kind of keep that in mind. Okay, go ahead. Question.
As far as the when you're going through this exercise and determining what your margin is going to be and things like that, it's very important that you start your research at that time and know what a reasonable margin is for any given industry, because that's what we're going to look at. We're going to compare what you're presenting us to industry averages, the margins, and the net income and things like that. So make sure it's reasonable. And if you can do better, tell us how you're going to do better and how why your margin is going to be better.
Are there, is it like is it by industry or what?
Yeah, we have outfits that we contract with where we have industry data. Now, you can do. You had mentioned trade associations and things like that, and just industry. It's not the easiest thing to find that information sometimes unless you pay for it. But do what you can to support that. Yeah, NAICS code.
There's a thick book called the U.S. Industrial Guide. It comes out every year, and it has every major industry in the book, and it has the different ratios for every industry. Just go to the library and pick it up, and make a copy of your particular industry, and it's done by asset size, and then by revenue size.
We'll just keep passing the mic. And just in case you don't want to go through the thick book that Rod's mentioning, just contact me. As part of the program, we have access to something called Vertical IQ. And it's exactly what they're mentioning. And we have it for access for free at City First Bank. And I'll just have to look up your industry and I'll send you the information.
That's a great tip, guys. There you go, free. Because that's going to help you understand exactly the benchmarks you need to use, right, for your industry. So, yeah, this is all good stuff. So we're going to have to figure out what your sales forecast is, okay? So you got to figure this out. You got to take your best guess on what you think you can sell and what the direct cost is. Then what assets do you need to support all those sales, okay? Then how will you finance that, right? Okay? So that's really important. So this is this is getting into how you actually build the financial elements of your business plan. Okay. So if you notice, this first step is really going to help us understand the income statement, and this helps us understand what? The balance sheet. So do you understand how to, I assume you know how to do that, right? So you understand the accounting model, right? You should know this. Assets equals liabilities plus equity. Okay, so assets are economic resources. The only reason we invest in assets is one reason and one reason only, to generate revenues. How do we invest in assets? We borrow money from the bank. That's called a liability, or we put our own money in. That's called capital, equity. Revenues minus the expenses is profit or loss. Whatever this is closed out to an account here. This is essentially the accounting model. So if you don't understand how it works, get a bookkeeper and an account to help you out, okay? Because we're going to pull off something called the balance sheet. We got 1, 2, 3, 4, 5 major groups of accounts that capture the transactions of the business. 5 groups of accounts. And these accounts, assets, liabilities, equity, they always have a balance in them. We call them balance sheet accounts. So we pull off the balance sheet from here. Revenues minus expenses, that's income statement. So you see how it fits? The accounting model is going to help you produce these financial statements. So it's good to understand something about that. Okay? So next slide. Now you're going to have to take your best guess as to what you think you can sell. Okay? We'll go back to the whiteboard a little bit. So in this example, this is an actual coffee shop that we did in Arlington County. And he made observations of different coffee shops. And he had 1, 2, 3, 4 different service lines. And this is how much he expects to sell at what sales price, and here's the direct cost to give him his gross margin. And once we figure out, by the way, once I figure out that first base year, what we'll do in the spreadsheet model, we'll apply some growth assumptions to get to years 2 and 3. So if you can just get through 1 year, if you can get that first baseline year done, we'll apply some assumptions to get the out years. So the exercise becomes much easier in the out years. But you got to give me your best guess in this year 1, this base year. Okay, that's going to be really, really important. Okay. And if you run a professional service firm, next slide, you're going to run into the same kind of issue, right? So if I have a professional service firm, and this is point 0, year 1, year 2, year 3. Finally, in year 3, I finally get my first contract. Yes, congratulations. There's 5 people, 5 business analysts. 5 business analysts. We're going to build them out during the year, 19, 20 hours. Okay, so most payroll out, some people use 2080. That's the total payroll hours. Whoops, sorry. Less, let's see if I can do this. So you take the total payroll hours. That's 2080, less what we call non-productive time. They're on vacation, sick. So most people will use 1880 or 1920 as total billable hours for full-time equivalents. That's how they run their revenue model. Okay, that's how they do it. So you got to tell me, you're going to bill them out at $75 an hour. There's 5 business analysts, 1920. This is how many payroll hours. This is their fully loaded labor rate, which is base rate, plus a burden, because you got to pay some of their Social Security and other stuff like that, right? So that gives me my gross margin. So this is, again, whether you run a professional service firm or you sell products, you're going to have to go through this exercise, okay? So it's somehow, some way, you're going to have to kind of go through this exercise that I'm kind of showing you here on the board, okay? Any questions? I'm going kind of fast. Y'all, you keeping up? Okay. Okay. Anybody else? Any questions at this point? Okay. Okay. Okay, we'll keep going. Next slide. So you have to figure out your sales price and your unit cost of what it is you sell to the customer. And most of the time, unfortunately, let me go back to the board and just make a point about something that I think is kind of interesting. So I said, if I remember, I said sales price times volume equals sales revenue. Okay, I understand that. I got it. Less, okay, the unit cost times the volume is my direct cost, right? Is the gross margin. Then I have all this indirect cost down here below. Whoops, that indirect cost. I don't know what I'm doing wrong. Sales price times volume equals sales revenue. Okay. Less the direct cost of what I sell. Volume times unit cost. Direct cost. I'll make this. Oops, sorry, I'm not doing a very good job. And this is my gross margin, and then I have less all my indirect cost. Okay, one point I'll make just very quickly is the direct cost tends to vary with the sales. So sometimes we might just call the direct cost variable cost. And the indirect, the month to month, rent, utilities. So we sometimes might refer to this as fixed cost. And the reason that's important is because that's going to help us calculate something called break even, okay? Then I have all the other costs, and that gives me my profit or loss. Okay, so here's what I want you to understand is if you, obviously the main thing you want to do is what? You want to become profitable, right? Right, that's obvious. So there's only certain levers that you can pull on. So the sales price, if I can get that up, the volume I can get up, and then maybe I can lower the cost. So basically, we might look at this as 3 levers I can pull on. The reality is a lot of times the sales price is dictated by the marketplace. So a lot of times people don't have a lot of leverage with the sales price. And they don't necessarily have a lot of leverage with the cost. I got to pay rent, I got to pay utilities, I got to pay the people salaries, blah, blah, blah. So where most people have leverage is where? Volume. Volume is where you probably have the most leverage. So one of the things I tell people, and it's just my opinion, is you've got to get out there and sell. Sales cures everything. I think you should spend half your time, 50% or more of your time, acquiring a customer, touching an existing customer, and pulling on that volume lever. In order to pull on the price lever, if you want your price to be above market price, which is, by the way, gives you more octane into the profit. If I want to really put some octane behind my profits, get the sales price number up. Well, that's not easy to do. How do you do that? That means people have to perceive that you add value above the marketplace. So how do you do that? Well, one of the things SCORE recommends is don't ever tell the customer or give the customer one option or choice. Give them choices. Give people choices and options to raise the value perception of the sales price, okay? Don't ever give the customer just one choice or one option. You want the customer to perceive a lot of value. And there's different ways to do that. Another thing I tell people to do is don't ever do only what the customer asks you to do. Go above and beyond it. Because that will they'll have a perception that you add more value than the other guy. You see what I'm doing? And that's going to help you also pull on the sales price lever to get high octane into your profits numbers. That's something I usually try to advocate to people, okay? Think about that. Okay, so, and if you don't know what your price should be, then you can do a bottoms up. You can figure out what the cost is and mark it up. But usually the sales price is going to be determined by the marketplace, and if you want the sales price to be higher, people have to perceive higher value, okay? Then the other side of the coin is you got to figure out what the unit cost is of what it is you sell, okay? And that's usually going to probably consist of at least labor, materials, and maybe some indirect overhead, okay? So if you're billing people out, it's probably their fully loaded labor rate, okay? There probably aren't too many materials that you charge, but in the government world, you might charge what's called ODCs. That's other direct cost, right? And you might have some indirect overhead. If you use a machine or a factory floor or other things that's directly used to make something, you might allocate some of those costs. So in this example, what we're doing is basically making some pants and saying, okay, the labor cost, it took 2 hours to make to sew the pants, $18 per hour for labor. They use this much materials. Then we have a sewing machine that's used, and we allocate a portion of the cost of the sewing machine to figure out what is the actual direct cost of making the pants. So this is kind of how you might think about figuring out your unit cost of what it is you make, okay? So you're going to have to kind of think about those things. Again, these are not easy exercises to go through. Sometimes I have people do time and motion studies, figure some of this stuff out. They put it in a notebook for each SKU. There's different ways you can go about this. But we've got to get these assumptions down so I can actually, because this is going to help me calculate the sales revenue number and the direct cost, because those assumptions are pretty important, okay? So we'll go to the next slide. And one of the things that SCORE recommends that you do is that you can compare yourself to other similar businesses, and you can get access to the financial information through databases. So we recommend you consider doing that, okay? So in this case, we were trying to look at a cafe, and we looked at different cafes, one in Annapolis, Maryland, other places, and we found that a lot of these cafes ramped up really quickly, but they had a ceiling. And we actually put some of these documents into the business plan to document our case study, okay? So now, again, I'm going to give you a link that'll help you understand what to do with this research. I'll give you the links to do the research in a minute. So the next slide is you can also look at their expenses. If you find something that's real similar, another company that's real similar to your company, we can look at that. And if you want to do this, I would recommend you go down to the Prince George's Library and get a library card. Because once you get the library card, you can access the database. And the link of the database is at the top of the slide. Okay? So this puts real hard research into your business and financial plan. So not only can you get financials and look at competition in detail, I can see their number of employees, I can see their operating hours, I can see how many everything, square footage, everything. Free. Library card, that's it. And by the way, we recommend you do two things. One database, two things. One database, two things. I said what? You gotta acquire customers, you gotta sell. Oh, by the way, we also recommend at SCORE that you generate a list of potential customers. You can look them up, find out by zip code who they are. And it'll give you a list, their name, address, everything. By lifestyles. So we actually opened a cat cafe. That's what I'm working with somebody right now. So we found women who happen to read a lot, certain income level, who love cats. We generate a lead generation list of those customers from the database. We export it to a file. I import it to MailChimp. I can send them postcards. I don't have to touch it. That's it. That's how we work that customer. That's how I have to get those customers coming in. Okay, so this is stuff that SCORE recommends you do. Put some of this hard research into your business and financial plan, okay? Okay, so next slide is I want to talk about the actual spreadsheet model that I'm going to give you so you can do this stuff. Like I said, you got to tell me how much stuff you're going to sell, at what price, sales revenue, less cost of goods sold, that's the direct cost of what you're selling, leaves the gross margin. And you got to break this out by months, by the way. So I have to have it out for 3 years, and I have to break it out by months. Again, the spreadsheet model I'm going to give you is going to help you out. So it's going to be but you'll have to put the numbers in. You're going to have to tell me what those numbers are. But I'm going to give you the spreadsheet model so you can do it. Okay. And this is just a kind of a similar breakdown. And in the spreadsheet model, we might have different products. I think the spreadsheet model has 5 or 6 placeholders for different places where you can put. Again, revenues less cost of goods sold for all the different products or services you're providing gives me the total direct cost. This is the gross margin, okay? Again, this is something you're going to have to figure out in the spreadsheet model, okay, that you're going to get from this workshop. And this is your operating expenses. Remember I said the direct cost was variable, but below there, what? I've got recurring operating costs month to month. This is some of the examples. Advertising, license fees, rent, supplies, utilities, Again, we got to break this out by month. So I got to figure out the variable cost, the direct cost that varies with the product or the service, and the indirect fixed costs that comes month to month, okay? Again, it's in the spreadsheet model that you'll get from today's session. And you got to tell me your startup budget. What's the total funds you're going to need? Some of it may be just one time. I got to go out and buy restaurant equipment, delivery vehicle, furniture and fixtures. I got to make improvements to the lease. And then I have recurring monthly expenses that I have to cover for a certain period of time before I can break even. Rent, utilities, payroll, stuff like that. So you got to figure all this out. Again, it's in the spreadsheet model. We break it out into these 2 different chunks. And we're going to balance that out against the sources of funding. So it balances out in the spreadsheet model. This will all be done for you in the spreadsheet model. It's going to make the exercise pretty easy. So these are the things you're going to have to do. For example, maybe you have one-time expenses of $172,000. A lot of these fixed expenses are hard assets. So these assets are depreciated. That means we allocate their expenses over their useful life. And in the spreadsheet model, we already have the assumptions in here. But you can change these if you want to. It's up to you. And then you have the monthly recurring expenses that you have to cover. So I got to cover all this. Total funds required to start my business. $213,800. One-time expense, once. Okay, so we break it out in the spreadsheet model that way. Again, you'll get a copy of that. Okay? And the next slide, you got to tell me where you're going to get the money from. Where's the money coming from? You put, in this example, you put your own money in, $115,000. Okay. Then you have maybe a loan, commercial mortgage on the real estate, a loan on the delivery vehicle, and this balances out. So we balance out all the money that you need versus the sources of money that you're going to use to start up your business, okay? And I will ask you guys a question is, what's the down payment? How much money do they have to put in?
Typically in a startup business, and I'll reference the SBA minimum, it's 10%. Obviously, the more you put into it, the better. But 10% is what we're looking at on a startup. If you have an ongoing business, it's depends on your net worth and your balance sheet.
Thank you, gentlemen. Okay. So you got to put some of your own money in, minimum of 10%. Okay. And then the balance sheet is your business checking account. That's the cash account. Receivables, money that customers owe you in the future. Inventory, that's products you sell. So this is the balance sheet as of the end of 2014, 2015, 2016. So again, the spreadsheet model will help you figure this out, okay, that you'll get, okay. And by the way, the current assets need to do what? Run through the cash account. You got to turn this stuff over. It can't just sit there, right? And then long-term investments should actually generate the return that the business gets back. That's kind of a basics of finance. And then the statement of cash flow is the third financial statement that's in the spreadsheet model. And it's going to basically say this is the money that was in your checking account at the start of the period and at the end of the period. And here's the money that came in and out of your checking account. Okay? Cash inflows, that's money coming in, and all the cash outflows going out. Okay? And it kind of reconciles your bank account. It helps me understand what's going through your cash account. And people like to know what's going through your cash account because unfortunately things sometimes go through the cash account that shouldn't go through there. Is that right? Like maybe they're paying off some personal expenses? You want to comment on it?
Yeah, I mean that is happens a lot when folks take advantage of either pull money out, expense items that they to reduce their income or their net income, which impacts your debt service coverage. So all of that, you got to do it right, but it's kind of a catch-22 sometimes if you strive to limit your tax liability.
Yeah, that does come up. So be careful. What should be running through your business checking account are business-related items. You need to firewall off the personal stuff. Okay, don't commingle it. Okay, and then you have to document the assumptions, like we talked about how much you're going to sell at what sales price. But there may be other assumptions, that you have to document, like how much is credit card sales, what's the variable cost, the direct cost that I produce, the product or service can sometimes be expressed as a percentage, right? Inventory. Then we depreciate stuff under the straight line method, which means I just write it off year to year to year in equal amounts. And the next slide is you're going to also need to understand something called break even. So I told you what? The indirect cost month to month tends to be fixed. So if that adds up to $50,000, okay, and I'm selling something, I sell it for $400, and the direct cost per unit is $200, okay. So what I can do is I can take and figure out how many units do I need to sell. If I do this formula, it gives me 250 units that I got to sell. That means I'm not making money or losing money. I'm just kind of breaking even. Okay, and if I just multiply that times the sales price, that's the total sales revenue. That's break even. So it's good to understand that. Again, the spreadsheet model that I give you will calculate that for you. It's a good idea to understand something about it. And basically, this is the form that you're going to use to kind of figure that out. Okay. And this link right here kind of gives you some additional. You can get an additional template or Google how to do the break even. Okay. And the next slide is the ratios. Now, it looks to me, I'm going to ask you guys, I'll put you guys on the spot a little bit. I took a shot at saying to myself, what are probably the most important ratios that you guys might look at? This is the three that kind of came to mind, what I thought. And I kind of redlined them a little bit to say that when you go to somebody for money, you know, you have to have enough liquidity on the balance sheet. What do you mean by that? Well, if I add up all the current assets, the cash, receivables, and all that stuff, it needs to be much higher than the short-term obligations. So current assets divided by current liabilities, that's called the current ratio. So these guys may look at that, and if that ratio is well below 2, that could be a little bit of a red flag to them. Likewise, they may look at your debt to equity ratio. That's total liabilities off the balance sheet divided by the total equity. Because if you have a lot of liabilities and a lot of debt already on the balance sheet, you may not have much borrowing capacity, right? And then finally, they may look at something called debt coverage ratio, which is how many times can I actually make those loan payments versus profitability. And I'll let these guys chime in because they probably can help me out.
So I wanted to make a comment on the debt to equity ratio. So the thing that you have to take out is the goodwill and trademarks or intangible assets. It's intangible assets that you have to take out, right? Because we're looking at tangible net worth, right? Or tangible equity. Now, typically what we'll look at first is I go straight to the debt service coverage ratio, because if it ain't 1.25, we don't have a deal. I don't even need to go any further, right? So I look at the debt service coverage ratio, then I turn back, right? And then I look at the debt to equity ratio, and then, you know, the current ratio, if I'm at 1.5 or above, then I'm typically okay.
We will definitely look at all three of those ratios. And I know from personal experience, I rely heavily on the RMA averages for any given industry. So 2.0 to 1 on a current ratio is going to be great. But if the industry average is 1.25, you know, we take that in consideration. And likewise for the debt to equity. But a lot of startups are going to have that debt to equity ratio kind of high because you're financing a good portion, especially if your equity injection is kind of skinny at 10%. So we understand that, but we will absolutely look at all three of those and compare them to the industries. You know, only if you're. It depends on what kind of loan you're looking for. Term loan, you know, those three. If you're looking for a revolving line of credit or something like that, we're going to pay attention, very, very close attention to the current quick ratio, things like that. There are other ratios depending on the type of loan you're looking
Just want to add that we take a look at the debt coverage ratio off the top as well. Another one that we may take a look at is leverage. We may take a look at the leverage ratio, but that's in conjunction with those three. You're the expert. But that was right. That's right.
Yeah, because that's actually right. Yeah.
That's right.
All right. So he made a comment about well, actually, he made a comment about the amount of equity put in. So what I find typically with professional services corporations is that there's not enough money put in from the beginning. And typically that leads to a higher failure rate, right? Because you don't leave yourself much room, right? If you typically after 3 years you're breaking even, year 4 you should be making money. That's typically the assumption, right? But if you've already underfunded your company by only putting in 5 or 10%, you haven't left yourself much room to be able to sustain losses, right, in those beginning years. So you actually want to put in as much money. Typically, I will tell people 20% is really what they need to put in. Now, the SBA says 10%, Now, if you have a restaurant or something like that, then I'm starting to choke a little bit. So you need to actually put in 20% if it's one of those high-risk industries like a restaurant, okay? Because we understand the high failure rate of restaurants. So depending on the industry that you're in, you really need to take a look at how much you're going to put in to get that business started, okay?
Thank you, gentlemen. Appreciate that. Okay. So these ratios are real important. And this link tells you actually how to calculate this ratio because it varies a little bit. So there's an actual formula. Yeah. Go ahead. You want to chime in one more time?
I'm asking since you're the professor. So should we actually tell them how to calculate that ratio?
The link will show you. Yeah. Yeah, because it's kind of complicated. You got to, it's a little complicated. I'm a CPA and I even struggle with it. So. Okay, whoops, did I scoot around? Where am I at? Whoops, I'm going the wrong way. Hey, let me get back. Oh, where am I? I got back. There we go, break even. So we got break even. We talked about the ratios. Okay, ratios are important. Okay, and these are not the only ratios. There's other ratios you can calculate to kind of assess the financial condition of your company. So there's other ratios you can look at as well. And like you said, you can benchmark these ratios as well. You can go to the public library. If you know your NAICS code, that NAICS code will kind of zero. If you know your NAICS code and your size, like he said, if I know the NAICS code and my size, I can Xerox those benchmarks and see what is a good ratio for my industry or NAICS code. Yeah. So that's something you might want to consider doing. Okay. So the next slide, now that we got ratios out of the way, just a reminder, when you walk into the bank, they want 3 years of projected financials broken out by months, okay? This is what they're going to want to see, not just the business plan, but also the financial plan and the business plan. And if you're going in, and maybe if you walk into the bank on August 1st, you may want to have financials through June 30th. And rather than, might be a good idea, that's called interim financials. That's what I mean by interim. So it's a little bit more current, so they know what's going on. I don't want to look back beyond, is that right? Interim. So maybe if I walk into the bank on August, you might want to have financials as of June 30th. That's what this interim means. Okay. Okay, so that's what we mean by that when we walk into the bank. Next slide is definitely got to have projected financials broken up by months. Okay, you got to have this in a balance sheet. Tell me your key assumptions. What do you think you can grow in the out years, for example? Because I'll apply those growth assumptions to the base year. Key ratios, we talked about 3 ratios. I gave you a quick example of how to calculate break even. I also showed you how to go in and get comparable financials through the library card, the link, right? Okay. So again, we can kind of embed and reference this kind of information, and this will help us kind of have a really solid financial plan and business plan, okay? So these are the kind of things we want to include. These are some of the things that I have seen. I mentor probably 250 people a year. And these are the things that I see that causes problems for me. And I'm going to let you guys chime in as well. A lot of times I'll read the financial plan. They'll give me the financial plan, and I'll look at the business plan, and they tell me 2 different things. They're not in sync. So that's the first, I run into that problem. They can't pass the ratio test. So I go in there and do a calculation and say, ooh, ouch. Looks like you may not pass the ratio test. Underfunded. You talked about that. I see that a lot. This lady wants to open a spa. She wants a loan for just $50,000. That's not going to get it. The leasehold improvements alone are going to chew up a quarter of that. I mean, let's be realistic, okay? Then also, I had somebody come to me 2 months ago. He wants a loan from the bank. He's got 3 people. He wants to pay $250,000 a year, including himself. The bank is not interested in financing you and your personal lifestyle, right? They want to fund the business. So that's another problem. okay? And be, I have other people come to me and they're very, very ambitious. So last night, here I am emailing a lady, and she wants to open a clinic in Montgomery County. And she's never done it before, and then she wants to do it. Three other things. Slow down, slow down, slow down. We got to focus on one thing, do one thing exceptionally well, and master that niche, okay? Don't go after too many things. Be realistic about it. Also, when you use the financial model and you tell me you're highly profitable, right? What will happen is cash will come. That's number two.
Everybody ready?
Welcome back. Okay. I had a little side discussion with our banker friends, and I was reminded of the fact that we talked about that debt service ratio was a real tripwire, but I was also told that we talked about the debt, that ratio was a real troublemaker. But the other thing is it helps to have some industry experience or something back. If you don't have any experience doing it, that can be a kind of a tripwire too, right? So,
All right. So when I'm going through the business plan, I mean, this is what I do in order. I look at the debt service coverage ratio. Okay. Typically, if it's not 1.25, I pretty much stop. Right. All right. But if it's a 1.25, then I look at, does the owner have industry experience? Okay. You can't have Rod Johnson opening up a cleaners, right? That's not my experience. So
okay.
even if you talk about, me buying a franchise, okay, then I'm probably not going to do it. Then the third thing is collateral. Because, we're not going to be, as I call it, naked on these deals, right? We need something to shore up the deal. And so what are those three things? Cash, marketable securities, or a second or third deed of trust on the home. Okay? I'm looking for those three things. I don't want artwork. I don't want the 750 IL BMW because that's been offered. Okay? I don't want any of those things. Cash, marketable securities, or a second or third deed of trust on the home are the three things that I'm looking for collateral, or combination of those three things. So if any of those elements are missing, I'm pretty much going to, decline it.
Okay.
Is anybody here looking at opening a franchise? Okay. That's one way to kind of get over the experience hump. And if you're not familiar with, become familiar with the franchise disclosure document for any given franchise and look at that. It'll tell you, what typical franchises, the gross revenue numbers. It'll tell you what type of training you're gonna realize and they're gonna provide and support, from regional people and things like that. But that's one way to get over that. And actually, that gives a lot of lenders a comfort level because there are ratings for each franchise. There are loss numbers, historical loss numbers, failure rates, things like that. So, if the right kind of franchise, it's going to help. Going to help.
You can hang on to the microphone. I got my own. Okay. So those are some additional points. So for everybody who's listening, industry experience, and if you want to mitigate that risk, sometimes a franchise model is a way to mitigate that risk. So that's a kind of a good point that they're bringing up. Okay. So the one golden nugget, I promised you I would give you a spreadsheet model. I want to give you that spreadsheet model, and that spreadsheet model is going to do a lot of things for you. It's going to help you generate the income statement for 3 years, broken up by months. It'll help you capture your basis of estimate. That means how much stuff you think you can sell at what sales price, your gross margin. It generates the balance sheet for you. Then we apply some growth assumptions to those numbers from the base year to get the out years, okay? There's a provision for up to 6 different product or service lines. And it'll generate the cash flow statement, the break-even, the ratios, and you can also put external benchmarks into the model as well, okay? And we need to know the NAICS code and size to figure that out. So if you want to, and I'm not going to kind of go through the spreadsheet model in detail, but here's what I would recommend you do. Download the PDF instruction template first. The template will help you fill out the template, and that will dovetail directly into the spreadsheet model. And you do it correctly. And yes, you may have to sit down with a CPA or an accountant. It is hard. So I have other people sometimes, they say, well, I'll meet with them. So it kind of depends.
Can we get this electronically?
I can send all 3 files to her when I go home today. I'd like to actually send you 4 files. Let me tell you what I'm going to send you. So about 2 years ago, I sat down with the Arlington County Public Library, and we developed a business case on how to do all the research through all the databases. So not only I'm going to show you how to do the research we talked about, I'm going to go way beyond that. So she's going to get 4 files when I go home today. And I need her to blast those 4 files out to everybody. That means you're going to be able to do extensive research that's real, rational, and objective in your business plan, and you're going to see these 3 artifacts. So you guarantee it. So we're going to give you a little bonus document that I didn't plan on giving you. Score. Yes. So we're going to give you more than you asked for. We like to go above and beyond the expectation of the customer, right? Okay. That's what we're trying to do when we service customers. So I'll spare you this, but the last point I want to make, and this gets back to what Ron, we started this whole thing, talking about the business plan, the components of the business plan, because here's the truth. The truth is that financial plan, that financial information at the top of the business model, here's how you have to think about it. And this is kind of advanced thinking, but this is the reality of it. So what I want you to understand is, unfortunately, when you look at a business model, you can think of it as a box, okay? And I can divide the box into layers, okay? I'll make 4 layers here. And the lower layer is what I call an enabler. It enables an outcome above. Whoops, wish I wouldn't do that. It enables an outcome above. This enables the outcome above. This enables the outcome above. The ultimate outcome I'm trying to get out of the business is what? I got to grow sales revenue. I got to get to profitability. So the reality is, if you want to educate on your financial plan, you've got to execute on what? These enablers that are below that he's talking about in the business plan. So if you can't attract customers and do good marketing, how are you going to have sales revenue? And how are you going to get customers if you don't have an efficient process, a high quality product, you see? So your business plan's got to speak to these enablers to execute on the financial plan. I'm going to turn this over to Ron and let him just reinforce this one last time.
Thank you, Matt. What I want to point to here, if you all look about 3 pages into your business plan, your notebook here, and take a look at the traditional business plan format. I want to go over a couple things there and kind of time together a little bit based on what we've been talking about for the last hour and a half. First of all, I want to mention for the folks that aren't here and don't have a notebook, the SBA website where you can find a lot of this information and a link to the business plan and all of the templates that help you get through that is www.sba.gov/business-guide/plan your business. You'll find a lot of very helpful hints there. Sure, it's www.sba.gov/business-guide/plan-your-business. Okay. Yeah, it's there, right, but we wanted to get that out for the folks that are watching the video. Now, looking at this traditional business plan format, a couple of things I wanted to point out. And really the first piece of the puzzle when you put that together is the executive summary. When you're looking at the executive summary and putting that together, that's your opportunity to give this high-level overview of what you're doing, how you're doing it, why it's going to be successful, why the lender should take a risk in granting you the loan. You want to focus on that. You can talk about competitive advantages, things like that. and really try to sell yourself to the lender. That's what you're doing. You're going to be doing that in the marketplace, so you might as well start with the lender. Second step is your market analysis. We've talked about a lot of research tools here today, and they're very, very valuable. And all of that analysis, that piece of the puzzle, kind of helps you. It's part of that foundation that was on Matt's last slide there. That look at the industry, look at ratios, look at net revenue, net income percentages, things like that. Then build your sales model. But it all starts with research. And frankly, I've learned a lot about available information that's out there today. So I think that's wonderful, and take advantage of it. It's going to be very helpful. Organization and management would be the next thing that you want to address in your business plan. We quite often run into a lot of questions during the closing process once you're approved with the business structure. So try to lay that out up front. You're going to be an LLC. I'm not an attorney, so can't advise you on what type of structure to form, but make sure it's done right. Take advantage of your attorney and set that up. But also include an operating agreement if you're an LLC and have more than one part. If you're an LLC, have an operating agreement. Quite often we don't see that. And the operating agreement is going to tell us, who's making the decisions, who signs, it's going to detail the function. It's not just a percentage ownership. It's going to let us know how the business is running. Service and the product line is the next step you want to address. Again, research. Research. Give us whatever the product is. Focus on the industry. See how competitors are doing, but be realistic. That's very important. Marketing and sales, very important also. It's the next area you want to address. Marketing strategy. Nowadays with online marketing, it's very effective and cheap, frankly. You don't have to, engage an advertising agency and spend thousands of dollars to do that. But have a plan. Have a plan. Take advantage of what's out there. Your funding request. Talked earlier about the use of proceeds. I want to say something about the use of proceeds too. We get a lot of folks come in and they say, I need a line of credit. Well, if you're buying equipment, you don't want a line of credit. Okay, and we're going to look at this and we're going to match it up. If you want a term loan, because it's any expense that's going to extend beyond one business cycle, you're looking for term financing. If you have to hire some employees, you're going to help you generate revenue. That's something that might be a more of a revolver. Manufacturing, if you're making a product, that could be a line of credit type financing opportunity. But just make sure you're matching your source of funds with the use of the funds. And then the next area really is the financial projections, and that's really the ultimate purpose of this meeting. And I think Matt went over that in great detail, and I'm familiar with the Excel worksheets and templates that SCORE uses, and they're very, very good. So take advantage of that. And then just, supporting documents in the appendix of any business plan, very, very important. I tell people this all the time, give us more rather than less. We'll sort through the information, and if we don't need it, we'll go ahead and shred it, but give us everything you've got, and be very honest too with your banker or your whoever the lender is, and treat them as a very valuable resource for your business. You're going to need them. As you grow, you're going to come back and need some more money. So basically, that's all I've got. So I guess now you want to take some questions.
So thank you. I want to thank Ron again from the FSC first. He has 30 years of banking experience and commercial lending experience, so he has a wealth of knowledge. And also, I want to thank Matt from SCORE, who has, again, a wealth of knowledge, having worked with individuals as they're starting up their business, and everybody else who's been in the room who's also contributing to today's program. So thank you, Rod, and everybody else here today. Let's open it up to questions. Who has a question? Who learned something or has a question about something they heard today?
Regarding the collateral that you're interested in, at what point, as far as the threshold of the loan amount, are you seeking home ownership? Just curious. Yes.
If I take a second or third deed of trust, all right. So what I'm trying to get to is 100% collateral, right? So to cover the loan amount.
Okay.
So let's just say it's $1 million.
Mm-hmm.
So if the marketable securities, when their margin gets me to about 80% of your loan amount, then the other 20% can be covered by, hopefully, that there's equity in your home. Now, if there's not really equity in your home, I'm still going to take a deed of trust on it, right? Because I want to be able to hold your feet to the fire so you get up every morning and go do what you say you're going to do. So either way, I'll probably take the second or third deed of trust in your home, but I'm hoping that there's some equity that'll cover a portion of the loan.
Okay. Thank you.
We need to get into this in another session. I would just say that there's also, there's personal credit and business credit, and depending upon how your company is set up, so there may be some differences in what's required. Right?
Now, I know we're here in Prince George's County, but if any of you are DC-based businesses, there is a program called the DC Cash Collateral Program where they will give 50% of the loan amount, right, as cash collateral to the bank. So they'll help you on the collateral shortfall, okay? So yeah, right. You got to live in DC. Yeah, and the business live in the business.
More questions?
Yeah. Yeah, so they have some good programs. They have some good grant programs too. Yeah.
I was asking, was there anything like that in Montgomery County?
No. Nah. Yeah. Not yet. But they realize they need to catch up.
I want to just piggyback a little bit on the collateral considerations. And Rod's absolutely right. Every lender wants to get one-to-one collateral coverage. There's no doubt about that. That's what we strive for. But I've been doing SBA lending now for about 25 years. One way to overcome that, when all the other considerations are positive, and there's a shortfall of collateral, we use the SBA loan programs to help cover that gap. We also have at FSC First, we have loan programs for fund managers for various state programs, county programs for Prince George's County, but state programs throughout the state of Maryland, where we can sometimes layer subordinate financing onto a project to get that bank loan, the senior position lien that the bank would have, or that first position lender, to get them more comfortable with collateral coverage. So there's a lot of different ways, that some lenders out there, FSC First is one. I mean, we can be we're creative lenders. That's what our motto, creative financial solutions. So there's ways to get around that. So if you're not one-to-one collateral coverage and got a great business idea, franchise, what have you, don't give up. There's ways to do it. You might have to, search a little bit, but it can be done.
Anything else? No? I guess I'll turn it back to you.
So that was a lot of good information. I'd like everybody to maybe let me know what was one thing that you learned today that you're going to take with you as you walk out the door. Let's start over here. Elizabeth, one thing you learned today. Let's pass this around.
Just what I need, a microphone. Um, you know, I love a microphone. The first thing and the best thing I learned was that 50% of what I should be doing is sales. Okay, I second that. And also, having submitted my SBA business plan this week, 8A business plan, I stand to be corrected. I will be making some adjustments with some of the direct debits that come out of my business banking account that will make a big difference in my profitability.
Resources for finding data on uh, potential competitors, my business, my industry.
I would say the most critical ratios to financing and creating your business plan.
With me, it's learning about the cash flow, and definitely learning about how to basically get a business plan started to get a loan, and that's what I'm basically looking for the business to get a loan because I had my business since '05, and I'm trying to expand the business, and the money that I'm using to make the the money I'm using from the business, I'm putting in back into the business, so I'm not really, the job is not really expanded the way it's supposed to. So learning this is showing me what to do and how to do it. So I'll be looking forward to getting, doing the business loan. So.
All right, I think what stood out for me early on was the difference between the full business plan and the lean business plan. So, which is, I think, why I showed up today to get the financial part
And for me, it was to stay focused on one entrepreneur area because my husband had just said to me, but you confirmed, he was like, you're all over the place. You're from this business idea to that business idea. You have the niche and strength to cook. Everyone loves your food. Stay with the food industry instead of wanting to be a public speaker. And I was just looking at buying a franchise, so I think I'm going to stay focused with what my niche is and my love is. My passion is cooking.
For me, I've learned the documents that the lenders are looking for, the exact documents. I didn't know that before.
How much I had to have to put into the business, as well as all the financial documents I needed to organize, because that's where I was stuck at.
And for me, I would say the ratio and resources were very helpful.
Excellent. Everybody learned something different, and thank you all for sharing because what I've learned in doing other programs is we all learn from each other as well. So view this as colleagues that you can learn from and share from. I just wanted to thank everybody again and just mention a couple things upcoming. We have February 27th, we're going to be looking at accounting basics for small businesses. On March 12th, we're going to be looking at the intersections of credit and what you need to know. So again, that's looking at personal credit versus business credit and making sure you actually have created business credit so that you can get more cash because you can get more cash as a business entity than you can as a personal, one that is using personal credit. Improving your chances of success and how to get to a yes will be covered on April 9th. And that we're going to also be talking about matching business needs to the right financial tools on March 26th. And so you heard everybody talk about if you're trying to get some equipment, if you're trying to get something else, there may be a different vehicle than what you think you need to get that. And based upon what your needs are, your documents may change, your ratios may need to change a little bit too. And then lastly, we're going to have the lender matchmaking event on April 30th. So everybody hopefully will have gotten through this session, got their documents in order, hopefully work with the Small Business Development Center and their technical advisors if you need somebody to look at your financial documents. If you're thinking you're going to need financing, you can meet with the FSC First folks here and the other bankers in the room to talk to them while you're here too, to find out what is required if you're going to go for a loan, right? So that material's in the back of the room. Anyway, I think we've had a great session. I don't know if any of the speakers want to add anything to their wrap up here. I'll let you all wrap up, and then we'll head to the next session in 2 weeks.
All right, I just wanted to add, one of the things we look at is your personal financial statement. So that also needs to be included in your business plan, because that's also key, what your personal net worth is. All right, so it wasn't stated, but I thought I would mention it.
Of course, I didn't bring business cards, but if you want to email me, and specifically my email address is dmoore, DMOORE, at cityfirstbank.com. And if you want to just email me your NAICS code, and I'll send you that vertical IQ information.
Nice.
The NAICS code will be the easiest and best to, and we just did it with Evelyn, so that'll be the easiest way. But my email address is DMOORE at cityfirstbank.com. And just, yes, good point. Yes. That's a good point. City as in CITY. Yes, good point. And just email the NAICS code and just give me a day or two. So, and I'll just, I think that was the easiest way for me to, and I'll send you the vertical IQ and they'll have your ratios and things that you need.
Hi, everybody. I'm Mark Wells from SBDC. What I do have for you is a hard copy of the SBA's version of how to write a business plan. As you leave, if I run out, in case I didn't expect this many people, you can just pick up my card and I'll send it to you. We also will all do all the things that they talked about today, cash flow analysis and things like that. And Devon knows that personally, so every loan I give him, the loan package is created in my office.
FSC first, anything you would like to add? No? So thank you. And as you see, these are the resource partners, right? So SCORE can help you. SBDC can help you with different aspects. The banks can help you. FSC can help you. The SBA is here to help you. We are all here to help you, including Prince George's County Economic Development Corporation. So thank you all for being here today. And we look forward to seeing you and meeting with each of you one-on-one to learn more about your business and your needs. Thank you.